This is lesson 4 of the Seido Trading Learn to Trade series. Up to this point, you've learnt how to identify candlestick behavior. You've learnt how to recognize momentum and how to understand trends. This lesson's all about simplifying decision making and removing any internal conflict that causes hesitation, inconsistency, and emotional trading. You will learn how to build a strategy that works for you around price action that fits the life that you want to live. Rather than adding more tools, this lesson covers how to focus on what matters and filter out what does not. As your read of price develops throughout this course, you will build a deeper understanding of how traders behave within trading ranges and how they respond to momentum, patterns that will sharpen your ability to identify high quality setups. Consistency as a trader is not built on winning every trade. It's built on your confidence in your understanding of price action, and confidence in your ability to execute the process you've developed. That confidence is what allows you to remain consistent over time, including through periods of drawdown. This is where a disciplined, rules-based framework becomes indispensable. Belief in the process is what sustains you when results are not going your way or you have a series of losses. Confidence is built through mastery and repeated deliberate action within a system you trust. Consider the athletes who entered losing streaks and never fully recovered. Not because their ability had left them, but because their confidence had. The best performers in any high-pressure discipline maintain belief in their process, even when outcomes are against them. And trading is no different. As traders, confidence should be among our most carefully protected assets. This is why we build trading strategies, so you trust your system. Your strategy sits within a broader trading plan, where your trading plan is a set of planned rules around how you approach the market and everything external in your life to maximize your performance. A trading strategy is a defined set of rules that guide each trade. It tells you when you are executing correctly and when you've made a mistake. Reading price action, constructing a trading plan, and reducing decisions to binary choices builds better outcomes and psychological resilience. It reduces the burden of decision making so that the decisions you do make carry genuine weight. There's a whole field of science that studies exactly this. It's called decision science and looks at how people make choices under uncertainty. And it consistently finds that simplifying information leads to better outcomes. Trading's no exception. The objective is not to predict the market. Certainty does not exist in trading. The objective is to reduce any internal conflict so that you can execute consistently, so that the results that you proved in testing become results you can replicate in live markets. The best traders often become discretionary later in their careers, but they arrive there by being rigidly rules-based early on. This is why we studied the criteria for strong bullish and bearish candles in lesson 1. Those criteria are mathematical expressions of strength. They are rigid rules you can apply to speed up your understanding of price. And they form the foundation of your strategy and give you something concrete to return to when your discipline is tested. Traders who lack confidence in their process hesitate when a setup presents. That hesitation creates a spiral: doubt, mistrust, and inconsistency. Over time, it stops being a bad habit and starts becoming an identity. Habits are hard enough to build. Breaking an ingrained one is harder still. So what's the fix? It's a strategy you've already proven to yourself, one that removes doubt before you ever sit down at the screen. So let's look at how to build a strategy. Every strategy has 12 components, each designed to ground you to the purpose of execution. So step 1, name your strategy. This is not a formality. Naming your strategy forces you to treat it as a system rather than a series of impulses. A trader who says, "I trade second legs," is in a different psychological position to one who says, "I read price action," or "I look for opportunities." The name becomes the anchor, something you return to when the market is testing your discipline. Choose something that reflects what the setup actually does. Step 2. Strategy overview. If you cannot describe your strategy, it is not defined enough to trade. Ambiguity in your description is a warning sign. It means ambiguity will exist in your execution. Write this as though you're explaining it to another trader. If they could not identify the setup from your description, rewrite it until they could. Step 3, market and time frame. So what market you will trade this strategy on, when you'll trade it, so between which hours. Remember, trading needs to fit your life. Most of us get into trading to have a different life than the 9 to 5 grind, so live it. Choose the time frame chart you will trade. If your strategy says that you use a higher time frame bias and then trade off a 5-minute chart, write this down. Step 4, the signal and the setup. This is not the entry. It is a set of conditions that tells you a trade may be forming. Your job here is to define what the market must be doing before you begin looking for an entry. This includes the market cycle, the structural condition, and any additional filters such as higher time frame context or volume. The more precisely you can define the signal, the more consistently you will identify it under pressure. So step 5, entries. Define your entry, the order type you'll use to enter, and any confirmation required before execution. Precision here is what separates a setup from a trade. Step 6, risk management. Risk management is the foundation that everything sits on. This is where you define your stop placement logic, your position sizing approach, and you define your maximum risk per trade for this individual strategy. Step 7, exits. Entries determine whether you're in the trade. Exits determine your actual results. A well-defined exit plan covers the 4 following scenarios. Your target is reached, your stop is reached, the trade is giving you an exit signal, or the trade is not behaving as expected. Partial exit rules and trailing logic belong in here. A common source of inconsistent results is undisciplined exits, driven by indecision in the moment. Your exit rules must be as clearly defined as your entry rules. Step 8, exclusion criteria. These are the filters that protect your strategy from low-quality versions of itself. Define specifically what disqualifies a setup. Higher time frame conditions, time of day restrictions, price action characteristics that suggest the setup is not valid. Every condition you add here is a decision you've already made in advance, which means it is a decision you do not have to make under pressure in a live market. It also gives you a concrete reason to miss a trade. If you miss a trade and it's not described here, it becomes a failure to execute your plan. Step 9, backtest your strategy. Backtesting, and this is what most traders hate, but it's where you find out whether your rules are complete. Initially, you're not looking for results. You're looking to build out this strategy in more detail to assist in defining your strategy. Then, when you have all the steps 1 through 8 clearly defined, log a minimum of 30 to 50 trades before drawing any conclusions. Record every trade in full, entry, stop, target, exit, and any notes that you may have noticed along the way. Pay particular attention to your losses. They will tell you more about the quality of your rules than your winners will. And get someone to review your results. This is where a mentor or advanced trader reviewing your log can often identify gaps which you cannot see yourself. Step 10, forward testing. Forward testing is where you find out whether you can execute on your rules. The gap between backtest results and your forward test results is a direct measure of your execution discipline. Use TradingView bar replay mode. Trade bar by bar as though it's a live session. No skipping ahead, no looking at what follows. Choose a date where you couldn't possibly remember the price action. Now log every trade and compare the results to your backtest. The point is not to achieve perfect alignment. It is to get close and build confidence that you can execute on your strategy. Step 11, summary statistics. Look at the results in your analysis and record them here. Head over to seidotrading.com and find our statistics page. Look at how many losing trades in a row your system expects to achieve. Own this number, because even with perfect execution, this will occur. Write it down and expect it at some point. While you're there, also check out your statistics align with your drawdown tolerance and adjust your strategy accordingly. Also record your risk of ruin. Remember, this is executing according to your plan. It doesn't take into account any failures in execution. Step 12, and this is the final step, ongoing refinement. But what does this actually look like? This is where you make notes about things that you see while you're trading your strategy that you may analyze moving forward. Ask yourself, is this change supported by evidence, or is it a response to a recent run of losses? If fewer than 10 trades support a change, it's probably recency bias. Document every proposed change, the evidence behind it, and your decision. What this does is it slows down any impulsive adjustments that destroy profitable strategies. So that's it. You now know how to build out your strategy. This is the exact process we use to build our second legs white paper and backtest the strategy behind it. We worked from a rigid set of rules built around our indicator, rules that produce defined, easy to identify entry signals with no ambiguity in execution. The indicator expresses momentum visually. So rather than analyzing every candle, it shows you when genuine momentum is present, removing the decision fatigue that comes from trying to read each bar in isolation. Let's walk through a live example of this in action, using the EMA pullback setup we covered in the previous lesson. This is the Nikkei mini futures on a 5-minute chart. As we can see, price opened and traded largely within a trading range. We then had a period of good momentum, as indicated on the Seido Trading indicator with these blue candles. When price pulled back to the moving average, traders used this as an opportunity to buy. Again, price then produced another momentum push as indicated by the blue candlesticks, giving traders another opportunity to buy as it pulled back into the EMA. All through here, it lacks strong momentum. When momentum does show up again, it's indicated with the Seido Trading indicator with these blue bars. Your coursework for the lesson is to start building out your strategy. You already know how momentum establishes itself, so build a strategy around this. Head over to seidotrading.com and grab the free Google Sheet template to assist you. It's in the Education Basics Lesson 4 course notes page. And if you'd like to see how a professional trading plan is built around a defined momentum setup, our research white paper and indicator is also available. That's it for Lesson 4. You now understand the importance of building a structured trading strategy, and you have the tools to develop your own strategy in the future. In the coming lessons, we'll cover consolidation patterns, including flags, inside bars, and trading ranges. I'll see you there.